Hi friends, welcome to Adda 24/7. We are in the Achiever series for BFM. Here we are covering all the important theory, numericals and objective questions. And remember, today we'll be covering the objective questions, very important ones, okay? So don't miss it and watch the series till the end. Okay, let's start. Okay. The dash isolates the short-term impact on the portfolio's value of a series of predefined moves in a particular market risk factor. The dash isolates the short-term impact. Very difficult question. Very difficult. Okay. First only it is a bouncer. Let me see how many of you can give the answer. The dash isolates the short-term impact on the portfolio's value for a series of defined moves in a particular market risk factor. Isolate. What is isolation? Isolation means like this. COVID. Suppose here, this is my market trend going on. Okay. And COVID happens. So this is one-off situation. This is isolation. So this isolation is done by whom? Simple sensitivity test, scenario analysis, maximum loss, and extreme value theory. So who does it? Think of it. Who does it? Yeah. Oh, I know many of you are typing this answer. Extreme value theory, EVT. Because why? I'll tell you the reason behind this. Why are you typing extreme value theory or maximum loss also? Some of you are typing. Because you see, simple sensitivity means simple. Simple. We all go by this English logic. Simple means simple. It will be simple something. Why will it cover this extreme something different? But the answer is different. The answer is the same. The answer is simple sensitivity. Simple sensitivity test is a test which can isolate. Remember, it isolates the portfolio's value of series of predefined this moves in a particular market. So simple sensitivity test is the right answer for this. Didn't I say it's a bouncer? First question itself was a bouncer. Today we'll be solving some numericals also. So that's why watch this till the end. Okay, numericals are still there. We'll be covering numericals. Okay. The dash, okay, next one. The dash specifies the shocks that might plausibly affect a number of market risk factors simultaneously if an extreme but possible event occurs. Plausibly means what? That will definitely. Plausibly means definitely, surely. These big words do come in your exam also. Number of market risk factors simultaneously means at once. Simultaneously means at once. At same time. I'll call it simple. Same time. Okay. So at same time. If an extreme but plausible event occurs, means what? What do you mean by this? See here. When COVID came, what happened? COVID. Few things happened. See here. First, health issues, health condition, deaths. Deaths were there. Health issues were there. Health. So it's always said in English, okay, that whenever the bad things come, they come at a worst time. So deaths were there. Then second was economy. Economy immediately went down. All your interest rates immediately went up. Bond prices went down. So economic problem. Then immediately third one, home. Isolation. Everyone had to sit at home. No work. Means work was there. Except the bankers, right? Bankers had to work at that time also, isn't it? Bankers are the, what we call, Amar, Ashwathama. Amar whom hai, right? Don't you think so? So bankers were working at that time also. The dash specifies the shocks that might surely affect number of market factors at the same time if an extreme situation happens. So what specifies? Simple sensitivity, scenario analysis, maximum loss and EVT, extreme value theory. So which one gives you the answer over here? What all scenes can happen? What all situations can happen? So who can give you this? Again, I am seeing many of you typing this EVT. No, EVT is not the answer. This is not the answer. So is it C, maximum loss? Maximum loss theory is different. That will be studying someday. Or that's why I say join the classes, paid classes, very lowest cost. Okay, join the classes. The answer is this: scenario analysis. Scenario, various scenes. I gave you that hint. Various scenes. Number of market factors means number of market risk factors means what? All these are risk factors. Death, health, economy, isolation. There can be many. You can go on and on, right? So we in scenario analysis we consider various scenarios. If this happens, what? If all the three come together, then what? If two come together, then what? If there's a fifth one, then what? That is known as a scenario analysis. Very important parameter while calculating the while we do the calculations for the various risk factors. Okay. So the dash specifies the answer is scenario analysis. Next one. The dash approach, see this, all of them we are covering, assesses the risk of the portfolio by identifying most potentially damaging combination of the moves of the market risk factors. So most potentially damaging, okay. So dash approaches the risk of the portfolio by most potentially damaging means which can affect me the most. Highest, hit it where it hurts, right? Or hit it hard where it hurts. That's what is the logic. So most potentially damaging combination. So what will be the same? Now the answer will be what? Many of you might have guessed it, right? What can be the answer? Okay, I'll give you the hint. Either it is C or D. C or D. Now, many of you might be thinking A was the first answer, B was the second answer. So now the answer will be C. So you might click C, but some of you might think reverse. That no. How can the answer be so simple? So the answer will be D. So most potentially damaging combination. The answer is C. C is the answer. Maximum loss. Okay, maximum loss is a combination. So here what do we see? All the 3, 4, 5 factors whichever was there, like the death happening in the COVID situation, the interest rates going up, then the countries facing the economic recessionary problems, right? People facing the isolations. All these came at the same time, and because of this, what all can be the impact on my economy? Total impact on my economy. So that is known as a maximum loss theory. Okay. The dash means, and the dash is the means to better capture the risk of loss in extreme but possible circumstances. Very simple now, isn't it? Now you say, sir, we know it. Move on, right? Move on. Move on. See here, the hint is also given. Extreme but possible circumstances. Extreme means extreme value theory. So see, look at this. Why did I cover these questions? Because I wanted to show you all the four methods. Okay, simple sensitivity, what is the use? Scenario, what is the use? Maximum loss, what is the use? And extreme value theory, what is the use? Okay, so that's why these four are of utmost importance, and these at least two of them are asked in the exam. Okay. Universal Bank had purchased certain bonds which it wants to sell now. Now, Universal Bank had purchased some bonds. So there is a bank which had purchased some bonds. Now it wants to sell. The bank expects some fall in the price of the bond. So now the bond is, let's say, might come down, the bond prices. Bond prices, no, what is this bond price and everything? Whenever I am in a bank, I'll have to purchase some bonds for my CRR, SLR, or even for my proprietary purpose. Proprietary means trading book. There are two books. One is banking book, second is trading book, isn't it? Okay, let me show you. Books, there are basically three books, not two books, but generally we call two. Bank book, and second is trading book. Trading. Okay, book, right? Bank book and trading book. So in bank book, what do I purchase? I do purchase the bonds for compliance purpose, CRR, SLR. What do I add in this bank book? I add the various banking activities in this bank book. Means whatever income I get from my banking business. Trading book means here I purchase the bonds for, we call it proprietary purpose. Proprietary purpose, we call it, right? So trading book, proprietary means what? For my own profit and loss, P&L. Own P&L means I buy some bonds and whenever I feel the rate is high, I'll sell it. So that is for my P&L purpose. There is a third book called as merchant book. Merchant. But we generally, it's like that keeping the ledger of that customer. Means how many, let's say I'm having the customer Reliance. I'm having the customer Tata. I'm having the customer, let's say Airtel. So what all business, what all services I have given, what all products they have purchased from me, what all bonds I have purchased on their behalf. Understand this, what all bonds I have purchased on their behalf. Because that record is to be kept separate because these bonds are not my bonds, these are their bonds. So that is known as a merchant book where I keep the record of the merchants of my clients. Okay. But what is the answer for this now? Universal Bank has purchased certain bonds which it wants to sell now. The bank expects some fall in the price of the bond. Which of the following type of risk is the bank facing? Liquidity, market liquidity, asset liquidity, and credit risk. Very not difficult one. Okay, type. Yeah. So what is the answer? What do you think? Okay, let's look at it one by one. Liquidity risk. Liquidity risk means what? Nobody is ready to buy my bonds. Nobody is ready to buy my bonds. For example, if I give you the bonds of, let's say, which company? Some Kingfisher Airlines, Vijay Mallya's company, defunct long back, right? That defaulted. Suppose if I'm having some bonds of that and I tell you, sir, please buy those bonds. Will you buy it? Liquidity risk. Nobody is ready to buy those. But here, what are they saying? That this expects some fall in price. It means there is no liquidity risk. It might be sold at a lower price. Market liquidity risk means, market liquidity means what? Is the market facing a cash crunch? Cash crunch means there's no money in the market. Nobody is ready to buy. Why? Because of some serious issues. Anything. The RBI might have raised the rates. Whenever RBI raises the rates, there's a liquidity crunch in the market. Okay, so there might be no money. So is it so? No, it's not, nothing given like this, that they are facing the market liquidity risk or something. No, means there is a RBI has raised the rates or some problem has happened because of which there is no money left in the banking system. Nothing like that. So B is also not the answer. What about C? Asset liquidation risk. Yeah, that can be the point. Asset liquidation risk. Why? Asset liquidation means what? As my asset, specifically for my asset. What is my asset? The bond. Bond is also an asset which I have purchased. So this asset liquidation, I'm trying to sell it, but it is getting sold at a lower price. So that is known as the asset liquidation risk. So C is the answer. But what about D? Why not D? Okay, I have explained you all these terms. Let me explain you the last one also, credit risk. Credit risk is always of two types, remember. One is counterparty risk. Counterparty means we call it default risk. Counterparty. And second one is country risk. Always remember, credit risk is of two types. These two parts actually. Country risk means what? Your counterparty, suppose if you have sold some material to somebody, so that party might not be able to pay you because of what? Reason number one, the party itself is bad. It can happen. The party is bad. The party is a fraud. So that is a counterparty risk. But what about a country risk? It might happen that your party is in Afghanistan. Afghanistan, the party is good. But what does that Taliban says? No, 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 no. Don't give money outside. So that's why there's a country risk. Similarly, North Korea. Similarly, now Pakistan, Sri Lanka. What are these? These are all the country risk issues. All are the funniest part is, okay, how many of our neighbors are facing the country risk issues? Name them in the comment section. How many of our neighbors are facing the country risk issues? I'll name them. Oh, chalo. Pakistan, yes. Sri Lanka, yes. Maldives, Maldives is also a neighbor. Yes, that is also facing the problem. Nepal, again yes. Then which one? Bangladesh, okay. Still it's okay. Still it's okay. I'm not saying it's very good. So all our neighbors are in the same line. Only India is standing tall over here, right? That's why we should be proud Indians. All of you should have a pride about India. Because in this so difficult situations, we ourselves are the ones who are just standing tall. Okay. So coming back. So the answer is asset liquidation risk. Got it? Okay. Now we'll be solving two numericals over here. One day VAR of a portfolio is 50 lakhs with 95% confidence. In a month of 6 months, assuming 125 working days, how many times or days the loss on the portfolio may exceed the value of the portfolio 50 lakhs? This question will be surely there in your exam. Okay. So one day VAR is 50 lakhs. One day VAR is 50 lakhs. Means, what is 50 lakhs? It means how much can I bear? If I am a bank, I can bear 50 lakhs, up to 50 lakhs if the loss goes, then I am okay. But I am very much concerned if the loss goes beyond 50 lakhs. So up to 50 lakhs, I have taken in calculations up to 50 lakhs. Okay, right? Above 50 lakhs, 50 lakhs, concern. Okay. So now the question is, how many days will it be above 50 lakhs? That's what we have to solve now. So what do you mean by this? How to solve this? See, this 95% confidence. What do you mean by 95%? What do you mean by percent? Percent means 100, right? Percent is 100. So 95% means what? 95% means out of 100 days, 95 days, my loss is within 50 lakhs. Within 50 lakhs. Okay. So out of 100 days, for 95 days, my loss is within 50 lakhs. So for how many days is it above 50 lakhs? If for 95 days, it is within 50 lakhs. For how many days it is above 50 lakhs? Answer in the comment section. Simple. First standard maths. Out of 100, 95 are within 50 lakhs. So out of above 50 lakhs is 100 minus 95. So 5 days. See here, out of 100, 5 days, my loss is above 50 lakhs. So this is a concern for me. 50 lakhs, right? So this is a concern for me. Concern. Now in 100 days I am having 5 days. So what is the number of days given over here? In a period of 6 months, assuming having 125 working days, it's given 125 working days. It's strictly mentioned 125 working days. So don't consider this 6 months. Otherwise, what will you do? 6 months, sir. 6 months means 30 into 6, 180. So 180 days. But no, don't consider 180 days. It is given 125 days. So in 100, I am having 5 days as a risk part. See this. What will I call this? In 100 days, I am having 5 days as risk. Right? Because this is my risk. Up to 50 lakhs is no risk. Okay. So in 100 days, I am having 5 days risk. So in 125 days, how many days will I be having the risk? So this is a direct proportion. It will be more. Always remember the difference between direct and indirect proportion. In direct proportion, we have dn upon n, right? So I'll multiply this. So it will be 125 dn means denominator into numerator, right? Upon numerator. So 100. See, this is numerator, this is numerator. 125 into 5 cross multiply upon 100. So it is what? 125 5 is what is that? 500, 625 upon, so 6.25, 6.25 days. So this is my answer. For 6.25 days, okay, my portfolio will exceed, okay, my 50 lakhs for 6.25 days. Isn't it? This question comes for 1 mark. And if you know the basics here, I have taken here almost 3-4 minutes to solve this. In exam, it will take hardly 10 seconds. Why? Because you know it. If you know it, it's very easy to solve. 100 minus 95, right? Simple, 5 days. In 100, 5 and 125, how much? How much? 6.25, right? Simple. A 5-year, 10% semi-annual bond has a basis point valuation of 125. So yield has decreased by 5 basis points. What is the profit or loss due to this increase? Now, very, very, very simple. Let me write it. V simple. Third V also. You can write 5 V also. V simple. But you must know it. Only then it is simple. Otherwise you don't know. You can't solve it. Firstly, you need to understand what do you mean by basis point valuation. Basis point value. What do you mean by this? Basis point value means the change in the price of the bond. Let me write it over here. BPV means what? BPV means what? Change in the price of the bond. Change in price of the bond. Okay? Change in price of bond. For what? For this 100%. So 0.01%. Look at it, 0.01% change in the rate of interest. Change in ROI. ROI means benchmark rate. Benchmark means, let's say repo. I'll give you a simple example as repo. For 0.01% change in the repo. So it's called as 100th%. Actual word is 100th. Means you divide 1% into 100 parts. Okay. So that way, that much percentage change in the interest rates or in the repo rate, if it happens, then what is the change in the price of that bond? That is BPV. So that's why you need to understand here, there are two methods for market risk. One is BPV and second is duration method, modified duration. You need to learn. That's why I'm saying join the paid classes. Cheapest cost is it's available. Means it's less than the cost of your pizza. Okay, isn't it? So that's why join it. Okay. So coming back, what is the answer for this, everyone? Now I told you the meaning of BPV. So now give me the answer. What does it mean? What does the question say? BPV of 125 means what? If there is a 0.01% means 1 BPV change. 1 BPV means what? 0.01%. So if there is a 1 BPV change, let's say change, okay, then the price of my bond changes by, price of the bond changes by 125 rupees. 125. That's what is said over here. So now what have they given? If my BPV is decreased by 5 basis points, so now for 1 BPV I am having the price change of 125. So for 5 BPV I'll have the change of what? What will be the change? So it will be simple. 125 into 5. This proportion. So it is 625. 625. So that is my profit, isn't it? So this is my answer C. Remember 625, just multiply it. Okay. Now the problem over here is profit or loss. That is the question. Profit or loss, C or D? Now understand one thing. Okay. C, I gave you directly the answer because I'm doing this for many years. That's why I know it's a profit. Now I'll give you the logic behind this. See this. Whenever the interest rate falls, everyone pay attention. Whenever the interest rate falls, interest rate goes down, the price of the bond goes up. Price goes up. So whenever the price goes up, I'm in a profit. Suppose if I had brought this bond for 100 rupees, now the price is 105, so I'm in profit, I'll sell it, isn't it? So that's what the meaning is. What is given? If the yield decreased by 5 basis points, the interest rate, yield means interest rate, okay? There are various names to the same word. Yield, interest rate, then YTM, asking rate, various. Inflation also some books call it. So that is also anything is called, okay? Market rate. So the interest rate, yield, or anything you call it, decrease. So interest rate has gone down, so price will go up. So I'll be in profit. So that's why my answer is 625 profit, not loss. Because many of you might have got confused in C and D, whether it's profit or loss, right? So it's profit. Okay.